What is up, investors? I don't know if you've been paying attention, but some of the most boring but profitable stocks in the stock market are excellent deals right now. And these are the water utilities. So, as the question in front of you asks, what are you waiting for? You better check these companies out. So, now that I've probably lost like half of you due to that terrible pun, I think we should answer the question, why water and why right now? So first off, why water? Humans are about 60% water. It's a huge part of our organism and we need it. We can only last about 3 days without water, so this is obviously a product that's going to be in high demand as long as humans are around. That's not even to mention the fact that our crops need water, many industrial processes need water, so water is a huge part of our everyday lives. In fact, global water demand is expected to increase 20 to 30% by 2050. And even though demand is increasing, supply is decreasing. As in 1961, the per capita amount of water in the United States was 15,300 cubic meters, but that has dropped to 8,600 cubic meters per capita in 2019. And the even crazier part is that the United States still has approximately 1.5 times more water than the global average. So we're seeing our water supplies per person dwindle, and we have more than most people. So that should really put into context just the amount of demand and the amount of supply crunch we could be witnessing with water in the future. And so that obviously leads into why now. There's going to be huge growth in the future, but currently higher interest rates have been a burden on utility stocks. That's because these utilities have high levels of debt, and so when they have to service this debt, they have to do so at higher rates, which costs them more money. But even though these utility companies are paying more on their debt, they are regulated monopolies, which means basically the local and state governments allow them to control certain areas with zero competition. And the trade-off is that these local municipalities tend to set the prices or the amount of profit that these companies can make. So will water ever be a major growth industry? Probably not, but by nature, they will always have customers, and those customers will always be paying them enough money to make a profit. And so that leads into number 3 nicely. As I mentioned, they are almost guaranteed to make a profit, and their margins generally depend on the local regulations, aka what kind of percent spreads they're able to make on the cost of producing that water versus the amount that they're charging people for that water, as well as infrastructure build out, maintenance, and acquisitions of other companies. And finally, one more reason to be invested in water is, as we saw, the amount of water available to us is going down, but the United States population is projected to grow from 335 million to 370 million by 2050. So again, more people and less water per capita tends to mean higher prices. But outside of that long-term qualitative information, there's also some really good quantitative information that says, hey, right now might be a pretty good time. So for example, the 5-year average PE for the sector is 31.44 times, whereas right now these companies are trading at 20.59 times their price to earnings ratios, which represents approximately a 50% undervaluation. Add on top of that, the 5-year sector average dividend is 1.94%, but today's average dividend is 2.76%, which is, again, approximately 50% higher than average. And I know what some of you are thinking. The last 5 years have had really low interest rates. That's caused the 5-year average PE to go extraordinarily high, much higher than normal, and that would obviously drive down the 5-year average dividend yield. But even if you take today's sector average numbers and you compare them across the last 20 or 25 years, the only time we've seen water utility stocks this cheap is during the global financial crisis, and that did not last very long. Most of these companies had their PE ratios expand back into like the mid-20s, upper 20s in just a year or two. So believe me when I say this is a very good time to be checking out these stocks. So the first stock I want to look at is American Water Works Company, ticker symbol AWK. And this company provides water and wastewater services to 14 states in the United States, constituting 1,700 communities and approximately 3.5 million customers. They serve residential and commercial customers, and they sign contracts with municipal customers in order to operate and manage municipal water and wastewater facilities. The company has 53,700 miles of pipes, 1,200 groundwater wells, 1,700 water pumping stations, and 1,100 water storage facilities, along with 74 dams. And AWK is headquartered in Camden, New Jersey. Checking out its forward PE, it's currently sitting at 22.59, with the last 3-year revenue CAGR in the low single digits and earnings CAGR in the higher single digits, with the gross profit margin of about 60%, a return on equity of about 11%, and return on assets of about 3.12%. AWK's price to book value is 2.36, and its current ratio is 0.65, which is low for the industry, but in general, utilities do have very low current ratios. And this company is expected to grow at 8% over the next 5 years and currently has a dividend yield of 2.39%. So some of the pros of American Water is that they have above average returns on equity and on their assets, and they have very solid growth projections compared to their industry. But on the cons, they have one of the higher debt balance sheets as shown by their current ratio, and they do tend to have some higher valuations versus their peers to reflect this above average return on equity and investments. Next up is American States Water Company, ticker symbol AWR, and yes, they are incredibly similar. I get them confused all the time. And this company provides water and electric services to residential and commercial and industrial customers in California. They provide water to 260,000 customers across 10 Californian counties, and they distribute electricity to 25,000 customers in San Bernardino County. Because many of these companies are super similar, I'm not going to go super in depth on their company profiles, but AWR is headquartered in San Dimas, California, and comes with a current forward PE of 23 times, with revenue and earnings CAGR higher than the last company we just looked at. The revenue CAGR is about 7% per year, and their earnings CAGR 13% per year the last 3 years, which is excellent. They have a great gross profit margin of 61%, return on equity of 16.82%, return on assets of 5.5%. Their price to book value is quite high at 3.33, but the current ratio is strong at 1.24. And American States Water is expected to grow at 14% per year, which is by far the highest we're going to see today. And just to add a little cherry on top, the dividend yield is currently sitting at 2.46%. So the pros for this company are pretty obvious. They have the top return on assets and return on equity of all the companies we're going to see today, and they have the highest expected future growth by a wide margin. But of course, this will lead to the typical cons of having the highest valuation versus peers and a lower dividend payout versus their peers. So you take the good with the bad. This is clearly one of the top operating companies in this space, but you're going to pay for that. Though given how historically cheap water companies are right now, this might be an exceptional company to take a closer look at and decide if it fits your portfolio. Up third, and sticking with the California theme, we have California Water Service Group, ticker symbol CWT. Now, this company provides water utilities outside of California as well. In fact, they serve California, Washington, New Mexico, Hawaii, and Texas, and they serve approximately 550,000 customers across those states. CWT is headquartered in San Jose, California, and their forward PE is currently sitting at 19.3. But the company has been struggling to grow its revenues. Its 3-year revenue CAGR is basically zero. Its earnings CAGR is negative 22.63%. And I do want to point out that this is more due to accounting things. These are diluted earnings that we're looking at these earnings CAGRs from. So on an operating basis, this company is much more stable than that, but on a diluted basis, they've taken some write-offs. So if you're more interested in figuring out why this number is so crazy big, you by all means go and do your own research. But to move on, the gross profit margin is in the upper 40s. The return on equity is quite low at 3.73%, and the return on assets is also very low at 1.13%. But the company trades at a pretty good price to book value of 1.85. Their current ratio is pretty bad as well compared to the industry at 0.69, though they do have an 8% expected earnings CAGR, which is pretty solid for this industry, as well as a 2.45% dividend yield. So on the positive side, California Water Service Group has better than average valuation metrics and pretty strong future growth projections, though of course these are reflections of the cons, those being poor revenue and earnings growth over the last 3 years and an industry worst ROA and ROE, which of course tends to mean that the company is struggling to operate in an efficient manner. Up next is Middlesex Water Company, ticker symbol MSEX, and they are a regulated water utility company that serves customers in New Jersey and Delaware, and they are headquartered in Iselin, New Jersey. If I said that right, I don't know. Anybody in New Jersey, let me know. This company has a forward PE of 21.35. Its 5-year revenue CAGR is 5.5%. Its earnings CAGR is negative 6.87%, but again, this number is reflected based on accounting principles that happen in the diluted earnings. So on an operating basis, Middlesex is a very solid, very consistent company. Their gross profit margins are 50%. Their return on equity is 7.5% approximately, with a 2.5% return on assets. Price to book is pretty decent, kind of in the middle at 2.03. Its current ratio is 1.05, so pretty solid, right in the middle of its industry. And its 5-year expected earnings CAGR is 5% with a dividend yield of 2.69% per year. Middlesex does have a stronger balance sheet than industry average, which is always a pro, and it is a solidly average company by most metrics. Its valuation isn't high or low. Its operating results aren't high or low. It's just solidly average, and that's not necessarily a bad thing. They're very consistent as a company, and that's what you're looking for, especially in a utility. But on the con side, they did have inconsistent earnings growth over the last 3 years. Again, that's just due to the nature of diluted earnings and how accounting principles can change those. And on the flip side of being incredibly average, there's nothing exceptional about your company or its valuation either. So I think Middlesex, like all water utility companies, provides an excellent investing opportunity, but it's probably the least interesting because it neither presents the best opportunity nor presents the best company to buy. Number 5, I think, is SJW Group, ticker symbol SJW. And this company provides regulated water services as well as non-regulated water system operations and management for customers in California, Connecticut, Maine, and Texas, with a total customer base of 175,000 connections and 1.5 million people. Interestingly, SJW also operates undeveloped land and commercial warehouse properties in California, Connecticut, and Tennessee, although these make up a very small portion of the company's operations. And in case you can't read what I just crossed out, SJW is headquartered in San Jose, California. The company's forward PE is 19.73. Its 3-year earnings and revenue growth have both been in the mid-single digits. Its gross profit margins approximately 58%, with a return on equity of 7.25% and return on assets of about 2%. SJW does have one of the lower price to book values at 1.41, but on the flip side, it has one of the worst current ratios at 0.58. The company is expected to grow at 7% per year and currently has a dividend yield just under 3%. So on the positive side, this is a industry best price to book ratio, and they have very solid past and future growth metrics. On the cons though, their balance sheet is in the worst shape among their peers as reflected by the lowest current ratio that we're going to look at, and their return on assets is quite weak compared to their competitors. So all in all, a pretty low valued company that has some great growth potential, but there are some questions about how much its balance sheet is going to affect that growth in the future. Up next is York Water, which is a super interesting company and a very, very interesting logo here. It's kind of ambiguous, but believe me when I say this is a really incredible company. They currently work to purify and distribute drinking water in Pennsylvania. They also operate 15 miles of pipeline and own some satellite groundwater systems and impounding dams, as that is supposed to say, not impounding. Now, what is so interesting about the York Water Company is that it currently holds the record for the longest dividend payment streak in the United States, which currently sits at 613 consecutive dividends over 208 years. This company is the pinnacle of American stock stability, at least as far as dividends are concerned. I do believe this company, along with many of the other companies in this list, are both dividend aristocrats, and several of them are dividend kings as well. So that's just another pro that I forgot to mention earlier, is that these companies are very, 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 very good at paying dividends regularly raising those dividends. You can always count on your money coming from these water companies. So circling back to York Water Company, we can see that their forward PE is 21.52, which is slightly above the industry average, but their revenue and earnings growth are both just under 10% for the last 3 years. Their profit margin is an incredible 75%, with return on equity at 11%, return on assets at 4%. So this company is crushing their margins and their returns. They have a book value of 2.25, a current ratio of 0.86, which is like right in the middle of the pack, and a forward 5-year expected earnings CAGR of 5% per year with a dividend yield of 2.43%. So on the positive side, York Water has excellent past growth, and we might as well also add the excellent past dividend record because literally nobody else can surpass them. And on top of that extreme safety and good growth, we also have the best gross margins in the industry and the second best return on assets and return on equity. So this company is absolutely killing it in the operating environment. Of course, the cons to that would be that they have a higher forward PE and price to book value, but that reflects the strength of this company. And their earnings growth is expected to almost halve over the next 5 years, from that approximately 10% to about 5%. So now we are down to our final 2 companies, and the reason I separated these 2 out of their alphabetical order is because I personally own both of these companies, and I just want to make sure that you guys are aware of that. I'm not trying to sell you on these companies. Please do your own research. Do not invest in anything just because I say I'm invested. But of course, I feel it's important to make that disclosure so that it doesn't seem like I'm trying to sell you something. You know, these might not be the best companies in the industry. These just happen to be the ones that I own. So moving forward with that, we have Artesian Resources Corporation, ticker symbol ARTNA, and this company provides services to Delaware, Maryland, and Pennsylvania. They serve about 100,000 customers and operate 1,470 miles of transmission and distribution lines. And Artesian Resources is headquartered in Newark, Delaware. With a forward PE of 17.77, this is the lowest valued company that we are looking at today on a forward price to earnings basis. The company has a revenue CAGR of 3.9% over the last 3 years and a small drop in earnings over the last 3 years of negative 2.35%. Its profit margins are just under 50%, return on equity is about 8%, with return on assets about 2%. Artesian Resources trades at a very healthy price to book value ratio of 1.58 and has a comparatively good current ratio of 1.37. The company is expected to grow at 4% per year for the next 5 years, which I do believe is the lowest number we've seen, though its dividend yield is on the higher side at 3.28%. So moving over to the pros of Artesian Resources, we have the best forward PE in the industry, as well as the second best price to book value and dividend yield among its peers. This company also has a very strong balance sheet. On the con side, the last 3 years of earnings have been a little bit bumpy, although we could basically assume that they've been stable. On the operating side, it has been pretty stable. So this company certainly doesn't appear to look like it's about to go into oblivion. It's just had a few write-off years. And on top of that, future earnings growth is expected to be slow. So this is not a company that's going to grow very quickly, especially when you compare it to some of its other peers that are growing at twice the rate and even up to like 3 times the rate as Artesian Resources is. And finally, we have Essential Utilities, ticker symbol WTRG. And again, I just want to reemphasize that I do own this company as well. I'm not trying to sell this company to you. It is just one of many great deals in the water utility industry today, and I think you should know about it. So what makes Essential Utilities a little bit unique is that they provide water and wastewater services as well as natural gas services throughout Pennsylvania, Ohio, Texas, Illinois, North Carolina, New Jersey, Indiana, Virginia, and Kentucky. They serve approximately 5.5 million customers, and they're headquartered in Bryn Mawr, Pennsylvania. WTRG has a forward PE of 18.06. Its earnings and revenue CAGR have both been double digits in the last 3 years, and they have a gross profit margin of just under 55%. ROE and ROA are both great. Their ROE is at almost 9% with a return on assets of about 3%. The company's price to book value is 1.66, which is on the lower side of the industry, though its current ratio is 0.62, which is also on the lower side of the industry, but that's kind of a bad thing in this case. But to get back to some slightly better news, the company is expected to grow at 6.4% for the next 5 years, and they have the highest dividend yield in the industry currently at 3.43%. So moving on over to the final pros and cons, we have the industry-leading dividend yield, which is always great for dividend investors. And of course, the forward PE and price to book value are very low compared to the industry, which does not seem to reflect the higher future growth potential of 6.4% when compared to some of its other peers. On the con side, its balance sheet is on the less safe side compared to its peers. Again, utilities tend to have current ratios that are quite low, so I'm not worried about the fact that the current ratio is 0.62, but it is one of the lower ones compared to all of the water utilities. And on top of that, the natural gas segment will bring a bit more cyclicality to Essential Utilities earnings versus a pure water play, because natural gas prices tend to fluctuate a lot more than water prices do. So this leads to some fluctuations in earnings that WTRG might experience that other companies on this list would not. And so the final thing I wanted to do for this video was to rank all of these companies against one another to try and figure out, hey, which companies are the best companies to invest in currently, just kind of on a very basic quantitative analysis. So what I did is I just looked at all of the different things that we analyzed, the forward PE all the way down to the dividend yield, and I ranked the top 5. So number 1 is in this column, number 5 is in this column, and the best companies would then be on the left-hand side of this list. Then all I did is I assigned a number. So if you were the number 1 company, you received 5 points. The number 2 company received 4 points. The number 3 company 3, then 2, all the way down to 1 point. And any company that did not make the top 5 received 0 points for that category. I didn't weight anything towards preferring better earnings growth or better return on assets. So everything is equally weighted. And this is just a very simplistic way of trying to figure out, hey, what are the best companies that we are looking at right now, combining both their operating excellence along with their earnings valuations. And so that is exactly what I had blacked out over on the right-hand side here. This is their final scores. We can see taking gold is AWR with 31 points. Taking silver is WTRG with 28. and Bronze YORW with 22 points. Again, I really want to stress that I don't think any of these companies look awful, and I'm really not sure that you could go wrong with investing in any of these companies just because their revenue and their earnings are focused on such an essential thing. You know, water is needed by everyone everywhere. I would certainly recommend checking out most of these companies. I think that the one that was least interesting to me was probably California Water, which is CWT. It did not get the lowest score, actually. Middlesex did it with 9 points, but I thought Middlesex was just kind of on the losing end because it was just average at everything. It scored a lot of 5s, as you can see here. Maybe it got really, really impressive and scored a 3 or a 4, but yeah, Middlesex just didn't do well in the rankings for scores, although I did think that just looking at these companies, they were probably more attractive than CWT. Other than that, for me, I think that York Water and American Water are both really, really interesting candidates that I'm going to look at for my personal portfolio. But I would love to hear what you think of this analysis. Which stocks are most interesting to you? Have you been looking into water stocks right now, or are water utilities just totally coming onto your radar thanks to this video? Any thoughts or comments you have would be greatly appreciated. And with that, I hope you guys have a wonderful day. I will see you in the next one.